You got paid this week, you saw the number, it looked fine, it looked pretty good, and then you watched it leave, rent, car payment, that subscription you forgot was still running, a minimum payment on a card you've been meaning to pay off for 8 months, a fee you don't fully understand from your bank. And somewhere in there, taxes took a chunk before you even saw it. You're left with less than you expected from a number that sounded like a lot. And the worst part? You're not entirely sure why. My name is Nick. According to recent data, Americans lose an average of $948 per person every single year purely from not understanding how money works, not from bad luck, not from laziness, from a system nobody ever bothered to explain. Today we're fixing that. 15 of the most Googled financial questions answered clearly without the textbook language. By the end of this, you'll understand your money better than most adults walking around right now. Let's meet Alex. Alex is 26, earns $55,000 a year, and is confused about basically all of this. We're going to check in on Alex throughout because a lot of what's about to happen to Alex has probably already happened to you. What is inflation and why does everything keep getting more expensive? You felt this one. You're standing in a grocery store, looking at your receipt, trying to reconcile the number on the paper with what you remember paying 2 years ago for the exact same cart. The math doesn't work. You're not imagining it. You're just experiencing something nobody named for you. Inflation is simply when money loses purchasing power over time. The Federal Reserve targets about 2% per year, a slow, controlled rise that signals a healthy, growing economy. The problem is that from 2021 to 2023, inflation didn't walk, it sprinted. It peaked at 9.1% in June 2022, the highest in 40 years. Groceries alone rose roughly 24% between 2020 and 2024. As of right now, early 2026, inflation has cooled back to around 2.4%. But here's the part that trips everyone up. Inflation cooling doesn't mean prices came back down. It means they stopped rising as fast. The car doing 90 slowed to 25. It's still moving forward. That $4 coffee from 2021 is still $4 and nobody is sending you a refund. This is why just saving money isn't enough. And that's exactly what we need to talk about next. But first, there's something following you around that determines whether any of this is even accessible to you. What is a credit score and why does it matter so much? Alex applied for an apartment last year. Good neighborhood, reasonable price, exactly what the budget allowed. The landlord ran a credit check, the number came back, and suddenly the apartment had just been taken. Alex sat in the parking lot for a few minutes and felt the specific shame of being quietly rejected by a number. Alex's credit score was 638. Your credit score is a 3-digit number between 300 and 850 that tells every lender, landlord, and in some cases employer, how reliably you pay back money you owe. It's calculated by an algorithm that does not care about context, circumstances, or the fact that you were 22 and didn't know what you were doing. The score comes from 5 things: payment history at 35%, credit utilization at 30%, then length of credit history, credit mix, and recent inquiries. On a $300,000 mortgage, the difference between excellent and fair credit translates to $60,000 to $90,000 in extra interest over 30 years. Same house, same bank. The system charges you more for having less, a detail nobody mentions when they hand you your first credit card at 19 and wish you luck. One thing to know immediately, checking your own score doesn't hurt it. That's a myth that has cost people years of not knowing where they stand. Ignorance here isn't bliss, it's just expensive. But how do taxes actually work? And is the raise going to hurt you? Alex just got offered a promotion, an $8,000 raise, and before the excitement had time to settle, a creeping anxiety arrived. What bracket does this put me in? Am I going to take home less? Alex almost turned down $8,000 because of a misunderstanding that roughly 51% of Americans share. Some of them have actually done it. The US uses a progressive tax system. Under current guidelines, your income doesn't all get taxed at one rate. It gets taxed in layers. The first $11,925 you earn is taxed at 10%. Income up to about $48,000 is taxed at 12%, then 22%, 24%, climbing to 37% only for income above $626,000. If you earn $50,000, you are not paying 22% on all of it, only on the thin slice above the 12% bracket. Your effective rate is much lower than your bracket. And before any of this starts, the standard deduction removes $15,750 from your taxable income entirely if you're single. A higher bracket never, under any mathematical circumstance, means you take home less. Alex took the raise. Pass it on. Apparently, 51% of people need to hear this, and most of them won't hear it anywhere else. Why do stock markets go up and down? Stock prices move on what millions of people collectively think a company will be worth in the future, not what it's worth today, what people expect later, which makes the market less like a calculator and more like a giant mood ring with a $40 trillion price tag operated by people who read too much Twitter. 4 things move markets the most: company earnings, economic data like jobs and inflation numbers, Federal Reserve interest rate decisions, and big macro events, elections, trade policy, geopolitical chaos. Imagine it's next year, April 2027. Let's look at a hypothetical scenario. Imagine sweeping tariffs get announced. Over 2 days, $5.8 trillion in market value disappears. Then 1 week later, a tariff pause is announced and the S&P 500 gains 9% in a single day. The companies didn't change. Their products didn't change. Investor feelings changed. $5.8 trillion moved by feelings. This is why trying to time the market destroys returns. You have to be right twice: when to sell and when to buy back in. Almost nobody is. Your feelings in this context are a liability. What actually happens when you invest in a stock? When you buy a share of stock, you buy a small piece of actual ownership in a company. 1 share of Apple means you own a fraction of Apple. Its products, its cash, its future earnings. When the company becomes more valuable, your slice does too. You make money by selling at a higher price than you paid, or through dividends, profits distributed directly to owners. Stocks feel like gambling because the price swings. But gambling is zero-sum with a house edge. Your expected outcome over time is negative. Stocks represent ownership in businesses producing real goods and real profits. Over 150 years, the US stock market has averaged roughly 10% annually. The casino analogy falls apart the moment you run the actual numbers. About 62% of American adults own stocks in some form. The wealthiest 1% hold about 50% of all stocks, not unrelated to the fact that they also started earlier. Which brings us to the concept that makes earlier always better. What is compound interest and why do people act like it's magic? Because over long enough periods, it genuinely looks like magic. The math gets surreal in a way that should make you either very motivated or briefly furious at your younger self. Compound interest means you earn returns on your returns. Year 1, you earn on your original investment. Year 2, you earn on that plus last year's gains. The base keeps growing, so the growth accelerates. It starts slow enough to ignore, then becomes the dominant force in your financial life. Invest $250 a month starting at $25 at an 8% average annual return, and you'll have around $878,000 by age 65. Start at $35. Same amount, same return, and you end up with only $375,000. The difference is over $500,000 from contributing only $30,000 more in principal. Compound interest generated the rest silently while you were doing other things. Alex is 26 and started investing $250 a month last year. Alex doesn't feel it yet. The numbers are still small, still unimpressive, but the clock started. And the clock is the whole point. The same math runs in reverse. The average credit card APR is nearly 24%, compounding daily. A $5,000 balance at 20%, paying only minimums, takes over 20 years to eliminate and costs more in interest than the original debt. Like compound interest builds fortunes quietly on one end and dismantles them just as quietly on the other. The only question is which side you're standing on. What is a 401k and why does everyone keep talking about it? A 401k is a retirement savings account through your employer, with 2 things most investments don't offer: tax advantages and free money. Most people are currently leaving on the table. The traditional version lets you contribute before taxes. The Roth version flips it. Pay taxes now, everything grows and comes out tax-free later. In 2026, you can contribute up to $24,000 per year. But the feature that doesn't get nearly enough emphasis is the employer match. Typically 50 cents per dollar up to 6% of salary. If you earn $60,000 and contribute 6%, that's $3,600 from you and $1,800 from your employer for doing nothing except enrolling. Credit card companies spent millions designing minimum payments to keep you paying forever. Your landlord didn't build in a discount for being a good tenant, but your employer will hand you free money every single pay period, and only 52% of workers with access to a 401k actually use it. The other 48% are leaving part of their salary uncollected. Alex enrolled the day after learning about the match. It took 4 minutes to claim money that was already theirs. Why can't I just save money instead of investing? The national average savings account pays 0.39% APY. Inflation is running around 2.4%. That means your money is losing purchasing power every single year in a standard savings account, and the bank is absolutely fine with that arrangement. Over 20 years, $10,000 in a regular savings account becomes roughly $10,800. The same $10,000 in an S&P 500 index fund becomes approximately $67,000. Same money, same 20 years, a $56,000 difference entirely from where you chose to put it. Your emergency fund belongs in a high-yield savings account, like accessible, stable, boring on purpose, but a savings account is a parking spot, not a destination. For anything more than a decade out, money sitting at 0.39% is getting quietly poorer while the market compounds at 10%. Saving is safe the way standing still in a race is safe. You won't fall. You will definitely lose. What is the difference between good debt and bad debt? Good debt borrows money for something that grows in value or increases your earning capacity. A mortgage on a home that appreciates, a degree with real income upside, a business loan generating returns above its interest rate. Bad debt borrows for things that lose value immediately and generate no return. Credit cards at 24% APR covering lifestyle expenses. Auto loans on cars well beyond your means. Payday loans that make credit cards look like a favor. Total US credit card debt just hit a record $1.28 trillion. Average APR 24.35%. Someone carrying a $10,000 balance paying only the minimum will spend over $18,000 in interest before it's gone, and it takes 22 years. That's not a debt. That's a subscription to being broke, billed monthly with a 22-year contract buried in the terms and conditions that nobody read. Meanwhile, 90% of millionaires built their wealth through real estate, almost all using mortgages. Good debt, used with clear eyes, is a tool. Like bad debt at high interest rates ensures your future self has less than your present self. The word is the same. The outcomes couldn't be more different. What is net worth and how do I figure out mine? Your income is how much is coming in. Your net worth is how much is actually staying. For a surprising number of high earners, the gap between those two numbers is the financial story of their life. Add up everything you own, cash, investments, retirement accounts, home value, car, subtract everything you owe. Mortgage, student loans, credit cards, auto loans. The median for people in their 20s is around $6,600. A person earning $200,000 a year with $400,000 in high interest debt and nothing invested has a worse financial position than someone earning $70,000 who's been consistently investing for a decade. The salary looks impressive at dinner. The net worth tells the actual story. Alex calculated their net worth last month. Arik stared at the number, negative $8,000. And felt that specific unpleasant moment of the math of your life seeming to work against you. Then wrote it down and decided that a number you know is always more useful than a number you're afraid to check. The people who never look are the ones who stay stuck. Why are housing prices so high, and will they ever come down? At some point in the last 2 years, you probably opened a real estate listing for a house that needed work. laminate countertops from 2003, carpet the color of disappointment, saw the asking price, and had a quiet existential moment. You're not being dramatic. The numbers are genuinely broken, and the people profiting from them would prefer you blamed yourself. The median home price hit an all-time record of $446,000 in mid-2025. Monthly payment with 20% down runs around $2,000 before property taxes, insurance, or the water heater deciding it's done. The US is undersupplied by an estimated 1.2 million homes. Zoning laws make new housing slow and expensive to build. Millions of homeowners locked in at 2 to 3% mortgage rates in 2020 and 2021 aren't selling into a 6.5% market voluntarily. So inventory stays frozen. And 72 million millennials hit peak home buying age simultaneously into a market with almost nothing in it. Will it crash like 2008? Almost certainly not. In that crisis was reckless lending to unqualified borrowers. In the current market, 79% of new mortgages go to super prime borrowers, and serious delinquency sits under 1%. The problem isn't bad loans, it's genuine scarcity. And scarcity doesn't fix itself until someone builds something, which, given current zoning laws and construction costs, nobody is in a particular rush to do. How do banks actually make money off you? Banks take your deposits and lend most of them out at a significantly higher interest rate. You put in $10,000, earn 0.01%, about $1 a year. The bank lends that money to someone at 7%, earns $700, and keeps the difference. U.S. banks earned $295 billion in net income in 2025. Your $1 was part of that. The industry collected roughly $5 billion in overdraft fees in 2024, charged to people who didn't have enough money. The fee for being poor, charged to the poor, extracted automatically, invisibly while you're asleep. 16% of people between 18 and 29 paid one last year. 6% of people over 60 did. Your money isn't in a vault with your name on it. It's been loaned to someone buying a house in another state. A high-yield savings account at 4% is a categorically different decision than a checking account at 0.01%. The bank uses your money either way. The only question is, how much of that return comes back to you? What actually is a hedge fund? Hedge fund is a private investment pool where wealthy investors hand money to professional managers who use aggressive strategies and short selling, leverage, complex derivatives to generate returns in any market condition. The name comes from hedging risk. The reality for most of them is charging enormous fees and hoping the market cooperates. To invest in one, $250,000 to $1 million minimum, net worth over $1 million, or income above $200,000. A standard fee, 2% annually plus 20% of profits, versus an S&P 500 index fund at 0.03%. In a famous bet from 2008 to 2017, Buffett challenged hedge fund managers to beat the S&P 500 over a decade. A simple index fund generated $854,000 in gains on $1 million. The hand-picked hedge fund portfolios averaged $220,000. After all that complexity, all those strategies, all those fees, they charged 2% plus 20% for the privilege of underperforming a fund you can buy in 30 seconds on your phone. For the idea that hedge funds represent some exclusive, superior form of investing regular people are locked out of, the numbers settled that question a long time ago. What happens to your money if a bank collapses? For most people, nothing. The FDIC insures deposits up to $250,000 per depositor per institution. If your bank fails, the FDIC steps in, arranges a takeover, and your money is made whole, usually by the next business day. Not a single depositor has lost FDIC-insured funds in over 90 years. The guarantee has survived 2 world wars, the Great Depression, the 2008 financial crisis, and everything in between. March 2023, Silicon Valley Bank, $209 billion in assets, collapsed after depositors pulled $42 billion in a single day, the fastest bank run in American history. The complication: 89% of SVB's deposits were above the $250,000 limit. The government guaranteed every deposit anyway to prevent wider contagion. Nobody lost their money. Bank failures are actually incredibly rare events. In 2010, 157 banks failed in a single year. In 2025, the system remained largely stable. The only genuine risk is keeping more than $250,000 at a single institution. If that's your situation, spread it. If it's not your problem yet, keep going. What is a recession, and should I actually be scared? Every few years, someone declares that everything is about to collapse. The charts look ominous. The people selling gold and bunker supplies are having a great quarter. The actual data: the US has had 34 recessions since 1854. The average post-World War II recession lasts about 10 months. The average expansion that follows lasts nearly 4 years. Recessions are the interruption, not the default. Economic winter: uncomfortable, temporary, and followed without exception by spring. By the time a recession is officially declared, the stock market is typically already recovering. Markets price and expectations, not current events. The official announcement is old news. JP Morgan found that missing just the 10 best trading days over a 20-year period cuts your returns roughly in half. Those days cluster almost exclusively around moments of maximum fear. Selling when it feels worst is statistically the most expensive financial decision most people ever make. Build your emergency fund, stay employed, don't carry debt that requires everything to go perfectly. And keep investing, because on the other side of every single recession in American history, the market ended up higher than where it started. Every single one. What this actually means: Alex is 26, earned $63,000, just enrolled in the 401k, started investing $150 a month, paid down $400 in credit card debt last month, and finally checked their credit score for the first time. Alex is not doing anything exceptional. Alex is just doing the things that nobody explained. The financial system isn't confusing because the people running it are malicious. It's confusing because complexity creates dependency, and dependency creates customers. The more intimidating it feels, the more products someone can sell you to navigate it. The confusion isn't a bug. For a lot of people, it's the business model. The $948 this video was supposed to save you, multiply that by 40 years of adult life. That's not a rounding error. That's life-changing money, and it doesn't require a hedge fund, a financial advisor, or a trust fund. It requires knowing the basics well enough to not get quietly taken advantage of by systems